Now.
Okay.
All right. So once again, warm greetings to all of you colleagues. I welcome you to our fourth lecture session in FAC 3764. Right. So currently what we are busy preparing for is pertinent to this year test or this assessment one, as it were, which weighs about 46% of your final mark, right? Or rather of your year mark. And it's gonna be, of course, a written assessment for 50 marks, and you'll be given a period of time to write it for about, I think, 2 hours, and then there'll be some extra minutes to help you guys upload and stuff like that. Right. So now, this, of course, will be in the next month of May on the 27th, unless otherwise there is any other corresponding communication maybe that they would issue for in case if there are changes. But I'm sure as it is now, there is a quiz that you are expected to complete. Um, I think if you check on my UNISA, there should be information or details pertinent to that. So please ensure that you complete it. Why I'm saying so is because with these webinars, um, it has a contribution to your year mark, which is about 8%. Because they're saying students will be required to attend a webinar and complete a quiz afterwards. Now, this together with the weekly quizzes, right? So there'll be some weekly quizzes that you guys will be expected to complete, right? Together with weekly quizzes will contribute 8% towards the year mark. So it's imperative that you constantly check on the portal to familiarize yourself with any pertinent information relating, of course, to the quizzes or even to the webinars, and just ensure that you attend them as well. That's very, very critical. All right, I think that was just all in terms of the administrative side of things. So just to revert to where we were from the previous session that we held, lecture three, there was a question that I wanted us to tap into, which was, of course, relating to the study pack. Now, but as it is now, we just wanted to conclude, of course, on learning unit one, dealing with the conceptual framework. And then I would then have to introduce you guys to income taxes, right? And then, of course, would look into the leases and then revenue from contracts. But what I was touching on last week, just before we close that lecture session, it was pertinent to learning unit number three, which is revenue from contracts. And that's what we're looking at in the textbook from chapter number five. Is it five? Let's check. Chapter four, sorry, not five. Right. Can you see it there?
Yes, I can see it's just a bit small because I'm using my cell phone whenever I
Oh,
attend.
whenever you connect. Oh, okay. All right.
Yes.
No, it's not an issue. So this is what we're looking at, revenue from contracts with customers. Leases, of course, is dealt with separately. There's some notes that they would give you guys relating to leases. I also have some which I'm going to share with you guys just to ensure that you can even look into them even on your own. Right. So chapter 16, chapter 17 deals with leases and stuff like that. But anyways, coming back to this, revenue from contracts. So the question that we were looking at in the study book, which is, I think, question one, right? Because we're looking into this question. Let me just go back to the question so that you can be at the same page with me. So in the question, they asked you to discuss the correct recognition, the correct recognition. In fact, let's do this. So they wanted you to discuss the correct recognition and measurement of transactions 1.1 and transactions 1.2 in the accounting records of DD Armour Limited, that is for the period ended 30 June 2022 in terms of IFRS 15. contracts with customers. So obviously, if you look into this, and then they say the discussion must be supported with calculations. So in this context, colleagues, they were really, yes, there's an element to do with conceptual framework, that is that chapter 2 in the textbook, but it's much more it's much more relating rather to your chapter 4, which is revenue from contracts with customers. So how they wanted you, because remember they are asking for, let me just go back to the question. They're asking for you to discuss two things. Number one, correct recognition of the transactions, and again the measurement of the transactions themselves. So the recognition aspect, of course, it has to do with, okay, how are you going to record the information pertinent to that transaction in the accounting records of that organization, and how are you going to do the measurement? So obviously the measurements, it will depend with what the transaction relates to. Is it something that results in revenue being generated by the company, or does it relate to something else altogether? So, but of course, in this context, it would result in revenue. But how do we go about doing that? So, if you go now into your textbook, revenue from contracts with customers, IFRS 15, right? It has got a 5-step process by which we can perform the recognition as well as the measurement of the transactions in question. So let's have a look into those steps. And those are the ones that I wanted to make sure you have a clear understanding and detail of what is happening there. Because in that way, you'll be able to understand the dynamics around the question that we are going to discuss now. So the first step is identify the contracts with the customer. That's the first step. The question is, how do you identify a contract with the customer? There has to be some form of agreement, or there has to be what we call consensus reached between the concerned parties. Okay, so obviously the concerned parties in this case, it will be the company in question and the customer, all right, or its customer, so to speak, right? That's how you'll be able to identify whether there is a contract or an agreement that has been reached by the company and its customer. So that's the first step that we need to establish. Then the second step is to identify the performance obligations in the contract. The performance obligations in the contract. So one could ask themselves, okay, what do they mean when they're saying, what is it? Identify the performance obligations in the contract. And notice all of these, step 1 to step 2, it's all to do with the recognition element of the transaction. The moment you go to step 3 and step 4, it would deal with the measurement. That's where the monetary aspect of the transaction comes into context. And then finally, of course, you then state or indicate exactly where this transaction would be captured in the financial records of the company. So that's the final recognition, so to say. So now in step 2, we identify the performance obligations in the contract. All of that would be stipulated. I'll explain, of course, about this aspect, right? To say when you identify the performance obligation, what does it mean? All right. So the performance obligation, it's like this. In fact, let me just try to indicate just so that you understand. So performance obligations, it's on both parties, guys. Performance obligations. So when there's a contract between a company and the customer, both parties rather have performance obligations to perform. What do I mean when I'm saying both parties have a role to play? From the company's side, their performance obligation is to deliver or provide either a good or a service to the customer. Does it make sense? That is the performance obligation on the side of the company. let me just try to expand this so that these things will make sense. And remember what I'm doing here, I'm just trying to give this information at a high level so that at least you have an insight understanding of what is happening within each one of those respective steps. Then we would, of course, then take it further by doing the application of this to the question that we've been given. So now, that's the performance obligations from the side of the company. Then what about from the side of the customer? So from the side of the customer is responsible for payment settlement. That's what the customer is supposed to do. That's the performance obligation that the customer has, is responsible for payment settlement. For what? For the goods or service that have been delivered to them. Does it make sense, Mr. Brendan?
Yes, it makes sense, Rolich.
Yes. Right. So that's the aspect about the performance obligations in the contract. All of this should be expressed clearly. In other words, when you go through the transactions, you should be able to clearly depict that, okay, so these are the performance obligations from both parties in this context. Right. And when you're doing the recognition of the transactions, you need to stipulate all of those things when you indicate each one of those respective steps. So essentially, for each one of those transactions, those steps are key, they're vital. You need to discuss and apply them. Then step number 3 is to determine the transaction price. So obviously, the transaction price, that's where the monetary value or the monetary aspect of the transaction becomes handy. So in some instance, you might find now it can be clearly given in the context. However, in some instances, you'll be required to perform a calculation. Okay? Hence, they are saying that in the context of the question, the discussion must be supported with what? With calculations. Does it make sense?
Yes, it does. It does. I'm still following with you. I'm with you.
Right. Wonderful. Wonderful. And notice that this aspect about transaction price, if it's inventory, you need to consider that it would involve all the costs, associated costs of ensuring that the inventory is, transported from the premises of the organization all the way up until it reaches to the customer. So all the costs involved. So we're talking about transportation costs, custom duty, and all that stuff. It should be included when you're doing the calculation of the transaction price. I'm talking in the context where you are dealing with um, inventory. So all of those factors need to be taken into account. So, but without any further ado, the next step is it's where you do the allocation of the transaction price to the performance obligations. All right. So allocate the transaction price to the performance obligations. That's the 4th step, right? So with this one, my brother, what is basically happening there, it's where, if in case the customer is going to be paying or rather do the settlement payment to the company, the agreement could be that the customer is supposed to be paying on a month by month basis. So you need to then allocate to say, well, in this case, the allocation to be that the customer will be expected to make regular payments monthly for X amount of money. Maybe it's 5,000 rands, especially if it's a credit sale that had been concluded. Does it make sense?
Just wait, just so I can understand. So you're saying the allocation transaction price to the performance obligation in the contract is,
Mm-hmm.
for example, uh, the agreement that they have basically when it comes down to the payment, if it's going to be a once-off payment or a
Yes.
monthly transaction or something
Yes.
in those terms.
Yes, absolutely.
Okay.
Yeah, that's the allocation aspect of it. So if it's a once-off payment, so it would indicate on step 4 that the the payment of the transaction price would be paid once off at X amount of money. So if maybe say the transaction price was R1 million, so we would need to clearly stipulate that the payment will be done once off in cash to the value of 1 million rands. That is if it's a once off cash payment. But if ever we have a scenario where the payment will be done on a month by month basis, then we have to clearly indicate or rather clearly allocate to say the payment for the transaction price will be settled over a period of, if it's 5 years, you state that it will be over a period of 5 years, but obviously converting that into months. So because you need to state the amount that will be paid monthly. So you say that it will be paid over a period of 72 months for 5,000 rands per month, something like that.
Okay.
Yes. So that's what is happening at step number 4. And then step number 5. This is where you recognize revenue when as the entity satisfies the performance obligations. Remember, the company cannot recognize revenue in their books unless otherwise they've ended, you know. So how would they have ended? They would have ended if they, on their side, they've performed their performance obligations to the contract in question. So that is if, for instance, if they were supposed to have transferred the rights and, privileges associated with the assets to the customer, then in that case, they would be in a position to then do a recognition of the revenue for that specific product or goods that they've sold to the customer in their accounting records. So they cannot recognize revenue unless otherwise they themselves on their side, they've performed their part. Making sense, sir?
Yes, okay.
Wonderful, wonderful, wonderful. All right. And just to make sure that maybe we clear this aspect. Okay, so I've tried to summarize it really. So I just want to take you through this briefly and then we can go into our question. So notice that in step 1, we must be able to identify a contract with the customer. And then, of course, this according to IFRS 15, that is our first step. So contracts must be written and it can either be verbal or even simply implied, So, but what is important, however, is that the contract is enforceable by law. So in other words, it has to be something that is legal. So if you get a transaction which seems to suggest that it's an illegal contract, this step number 1 cannot therefore be achieved. Then step number 2, remember, we must be able to identify the performance obligations in this contract. As I had already mentioned, that these performance obligations refers to the promises to supply distinct goods or services or bundles thereof. So, I mean, this is just to explain on the side of the one that is selling or providing the product to the purchaser. So in the case like what we have there, it will be the company which has this performance obligation to perform. And then on the side of the what you call it, on the side of the customer, their performance obligations obviously is to make sure that they do settlement payments, just exactly as I had already explained it. And yeah, I think pretty much that, guys. So then, of course, okay, most of these things I've already explained them, so I don't want to repeat what I've already explained. So what I can do now, let's go back to our question so that we can apply those steps to this question. Is that okay? So now let's go into
Yes.
our question so that we analyze each one of these transactions and then we apply the 5 steps. So I'm going to read again from the top. So we are told DD Armour Limited is situated in Gauteng, South Africa, and specializes in the manufacture and sale of armored vehicles. The armored vehicles are sold in South Africa and internationally. The company has a financial year ending 30 June every year. Now, so meaning to say that in terms of timeline, their financial year begins on which date, sir?
The 1st of July.
The 1st of July every year, right? And I think if we go back to our required section, we are dealing with the year ending 30 June 2022, meaning to say our timeline in this case would have been from the 1st of July 2021. all the way to the 30th of June 2022. It's very important. Your timelines are critical, colleagues, for purposes of evaluation. Right. Now, let's continue. Now, so this information that we've just read, Mr. Brandon, it's basically to give you a background information about what this company is involved in. So in this case, we can tell they're into manufacturing and selling of armored vehicles. So they have a product which is armored vehicles that they are selling to their consumers. And then DD Armor Limited offers customers the option to purchase a standard armored vehicle, or if they prefer, the armored vehicle can be made specific to their requirements. Now, custom-made armored vehicles take 9 months to manufacture and to deliver. All right, so this is just basically giving us dynamics that look, it's like a product differentiation that is happening there anyways. Now, all vehicles, whether custom made or standard, must be serviced every 15,000 kilometers. South African customers have an option to purchase the armored vehicles with a 120,000 kilometers service plan. A service plan normally sells for how much? 37,500. So what does this tell you? Remember, in the service plan, it's for how long? For how many kilometers there?
120,000.
120,000. So it means for each vehicle, if you want a service plan, okay, to that value, you need to pay 37,500 over and above the 970,000. Does it make sense?
Yes, it makes
So it's
sense.
actually part of the 970. No, it's actually
Also,
above. Is it above? No, it's over and above this 970,000.
yeah, so it says an armored vehicle without the service plan. So it's without.
Or the 970 it's without, right? Yes,
Without
it
the
is
service
without.
plan.
Yeah. So it is without the service plan. Meaning to say, if the company, if a customer rather wants a service plan, it means that's an additional cost there,
Yes,
right?
okay. Okay.
So meaning to say in this case, and oh, let's just go back again. All vehicles, whether custom made or standard, must be serviced every 15,000 kilometers. So let's
Kilometers.
find out 15,000 kilometers divided by 120,000 kilometers, right? Times that 37,500. I'm just trying to determine how much is that service going to cost the company.
More or less. Okay, it makes sense.
Yeah, that's what I'm just trying to establish there. Okay. All right, all right, all right. Okay. All right. And okay. All right. No, it's fine. There's just something I was just trying to determine there, but it's fine. All right. Let's come back and then to see something. 970,000 plus 37,500. Okay. Okay. So meaning to say, if we were to add the the 37,500 here, do you see that a vehicle with a service plan is going to cost something like 1 million
Yes, 1,000,000
and
seven
7,500, right?
500. Yes.
So this is inclusive of what? Of the service plan. Can you see that?
Yes.
That's wonderful.
So are we able to see, are we able to calculate how much is the service plan every 15,000 kilometers or not really?
We can. We can. It's very simple. So you take the 15,000 kilometers
Mm-hmm.
divided by 120,000 kilometers, and you
To get
multiply
them.
that by the 37. Is what? It's 37, right?
Mm. Do you divide it or do you times it?
No, you divide it.
Okay.
You divide, yeah. So you divide the 15,000 by the 120,000 kilometers. There's a reason why I'm stating that. But also I'm trying to consider, okay, let me just check something. All
So
right.
it's eight. So it's
This
about
step,
eight. So it's eight. So it's 37,500 divided by eight.
yeah, literally. But this one, it's a step. I think that's step number 3 that we are doing already. So
Oh,
I
okay.
think, yeah, I think let's just maybe finish the other steps so that everything flows. Then I'll come back to this one. Yeah,
Oh, okay. Yes,
but
yes, yes.
it's a very interesting exercise, definitely.
All right.
Yes, but I think, yeah, let's just maybe do the first 3 steps and get this
Yes, yes,
out of
yes.
the way. Then, yeah, we can then come back to the calculations. But it's a very interesting one, though. Anyways, so now the following information relates to the revenue transactions of DD Armor Limited during the current financial year. So, do you notice that so far from everything we've read from this point all the way up to here, this is giving you background information
All right.
about this company called DD Armor Limited in terms of their service offering. So what we have seen
Yes.
so far from this point up to this point, they're just giving us details about what product they are selling, how much they are selling it for, and what dynamics are they pertaining to the pricing of the actual vehicles themselves and also of the service plan. So there are 2 packages that we see, or rather 2 pricing that we are seeing there. Number 1 is the pricing for the actual vehicles per vehicle, which is 970,000. And then I'm also seeing pricing of the service plan for
Yes.
each vehicle. So already there are 2 figures that we would need to play around with. So, but let's find out now, coming back to this. On the 1st of August 2021, DD Armor Limited signed a contract. Okay, let me do this. Signed a contract with
Okay.
SG. If you may allow me to just change a color because I know I already have a lot of red colors there. Maybe blue would do. Okay. So what did they do? They signed a contract with S4G Limited, a South African security company, for the purchase of how many vehicles? 10
10.
armored vehicles. At how much? At what value?
985,000.
985,000 per vehicle. Notice this is including what?
Okay. 120 kilometer service. Yes, option.
So no wonder maybe the pricing is different. Do you see that?
Yes, yes, yes.
All right. So now the contract, okay, so already in per vehicle, including the 120,000 kilometers service plan option. Now, the contract requires, now I think they probably got a discount anyways, these guys. But let's see.
Yes.
Because if I take this 970,000 and try to subtract it from trying to get the difference between the 970 and the 985, it doesn't give me 37,500 for some reason, but we'll come back to that. Now, the contract requires S4G Limited to pay the purchase price in cash. Do you see that? On the date
Yes.
of delivery of the vehicles. And S4G Limited, what did they do? They took legal ownership of the 10 vehicles on the 1st of November 2021, and the total purchase price was also paid on this date. All 10 vehicles underwent the 15,000 kilometer service during the current financial year. So meaning to say, probably what we just need to account for, it will be the 15,000 kilometers service per vehicle. So we need to know how much is that amount, for the
Okay.
current financial year. I'm saying that for the purpose of the calculations that we're going to perform, right? So
Right.
now,
Right.
Mr. Brendan, here's what I want you to see. Um, yes, okay. I just wanted to open this. Now, I want us to do those steps now, one by one. For this particular transaction alone, for the time being. So, what was the first step that we're supposed to perform? So here's how
I
you
think
would,
it's
yeah. So here's how you would respond, right? So you'd state there that
okay.
according to IFRS 15, all right, and this is what revenue from contracts with customers. but you don't really need to write it there, but you can just say, according to IFRS 15, the following steps should be observed
Mm.
to perform the recognition and measurement of the following transactions. Okay? Because you know that the first transaction you're going to deal with is obviously transaction what? 1.1. You can either do the steps here separately, where you indicate your step 1. And remember, what is your step 1? Is to identify the contract, isn't it? Or the
Yes,
contracts
okay.
with a customer. So you state there clearly, identify a contract or contracts with a customer. So we need to state things that shows that there's a contract that was established in this case, all right? So how do we know that there's a contract that was concluded here? Well, they clearly told us that on the 1st of August 20.21, DD Armour Limited, what did they do?
Signed.
Signed the contract. Meaning to say this thing was documented. So we're gonna state that a contract was concluded and signed by, and then I would indicate the DD Armour Ltd. And who else?
S4G, I think.
Yes, and S4G on the 1st of August. So dates are critical because it does act as a form of basis or evidence that indeed something transpired historically in this case. So on the 1st of August 20.1, so a contract was concluded and signed by DD Armour Limited and S4G on the 1st of August 2021 to do what? To sell 10, there were 10 what? Armored vehicles, right? That's the only evidence that you need about that. So far, so good.
Yeah, so far so good.
Yeah. You can even state the price if you want. And sometimes, look, you can do it step by step, but also you can even combine those steps into one. But for the measurement aspect, you might need to then show it separately. Why I'm saying that, because with the measurement element, there's need obviously for calculations to be performed. So I'm going to show you one
Right.
way of doing it, two ways rather. So this is the one way where you show clearly the distinct steps, and then the other option is where you just write everything in one paragraph in terms of the recognition aspect. Then afterwards, you then do the supporting calculations below that, and then you give a conclusion at the end. That's another way of doing, or rather of responding to this question, right?
All right.
Yes. So now, so in this case, a contract was concluded and signed. In fact, let me just do the combined method. Why? Because it's quicker and it saves you time. Because most of these first three steps, they can be written in one statement, other than having to show it separately like this. But so far, with the
Okay.
first point, yeah, I will try to put it in bullet point form. So this is relating to the first step. And then I'm about to address the second step, but let me do that in the second video where I identify the performance obligations in the contract. So in video B of this same lecture, I'll be explaining now the step 2 and the rest of the other steps, because we're left with a minute before we can get cut off now.